So the map that beats the market. If you haven't seen my previous videos, they are integral to understand what I'm talking about here. I'll link both of those down in the description box below if you haven't. So the goal of this video is to show you how to map a narrative, because a narrative, as we've discussed in the previous videos, are key to understanding and providing that missing link to why most trading strategies typically don't work or eventually stop working, because it's what is driving price a lot of the time. Not every time, but a lot of the time in key scenarios. And so being able to map that in terms of actual data, in terms of actual facts, is going to be really critical when we're going and essentially building our edge. And that's confirming two types of narratives: the narrative that we have of what we believe to be true, but also understanding where the consensus is at. So what I want to do is I want to break down a few of these things, why it's important and how you can think about it. So first things first is I want to define the consensus. So consensus is the collective story that the majority believes is already priced in, right? So this is essentially the story that the majority of voices, or the loudest voices in whatever space you're in, believe. This is it's the consensus, right? And it's often what's also safe to say publicly, because as we've discussed in the previous videos, there is a lot of risk aversion that comes with a lot of, for example, analysts that speak with news sites and whatever. So why does this matter? Well, markets move when belief shifts, not when facts change. So I spoke about this in the last video a lot, and it's the simple idea that you can be right about something, but if it takes 2 years before that thing that's right comes to fruition and you've wasted time trying to trade that the whole way, you could lose more money than with any other strategy on the planet. So it's not just about being right. It's about being right, but also being able to map when things begin aligning with you. And so that shift only happens when consensus realizes or starts to realize that it's wrong, or new information forces it to adapt. So in other words, being early doesn't pay, as I've said. Alignment with the belief migration does. Now, the edge comes from spotting the pressure building under the story. So essentially, the prediction is still important before it flips. And because you know why things are shifting, sizing up when the consensus begins to agree with you, because whilst they're going, oh God, we're wrong, like we're scared, what's going on, let's just de-risk, you already know, okay, this is beginning to flip according to what I already knew, so I'm going to size up. When everyone's scared here, trying to unwind their buys and their longs, they're going to be like, oh my God, let me get out, let me de-risk and take risk off the table. Whilst they're doing all that panicking, this process can take weeks or sometimes months. You already have clarity. And so it gives you that clarity to be like, right, now's the time to pounce. That is where the edge comes from. It's that lag. It's not just about, oh, I'm right, others are wrong, sweet. It's about, I'm right, others are wrong, others are starting to realize that I'm wrong. Now's the time to really go in hard. Okay. And that is a skill. And that's why it's so important to be able to map narratives, which is what this whole video is about. Anyway, so who shapes consensus? So big media headlines, just big media in general. Institutional analysts, you'll find that especially in the stock market, but even on a macroeconomic level, analysts are everywhere. These can be people at institutions or academics that show themselves on the media circuit, on news circuits and whatnot. Then we have academics and think tanks. Then we have influential CEOs and policymakers. All of these things can have an impact. And depending on the market that you're in, whether you're in a kind of macroeconomic, asset class, or whether you're an individual company, the result is going to differ depending on which one you're going after and which one is going to have slightly more weight and all these sorts of things. But just as an overview, those are the things. So next thing is we want to understand the weaknesses. So again, I've spoken about this in the last two videos. They're not incentivized to take risk for the most part. They protect their credibility. If you think about it just logically, if you're somebody who is paid to show up on the media and talking about your opinions, it doesn't really pay to be the person that's always taking these wild risks or going against the public views, because your reputation's on the line, and most human beings are naturally risk averse. Secondly, a lot of people at these big institutions, these analysts, they are not trying to trade the same way as you or I. They are normally trying to trade in terms of protecting capital and allocating money in a portfolio. That is very, very different to the type of trading that I'm sure you are interested in and the type of trading that I am interested in. And so, therefore, when people say, oh, I just want to follow the smart money, it's like, why? What are you talking about? You know what I mean? So, next thing is they share the same frameworks, models, and biases. If we just take economics, for example, most people who are in the media, most people who are institutions, they've gone through the traditional education system. I'm not saying it's bad. I'm not here going, oh, education system's broken, needs to change. It's just a fact. They've gone through the same education system, and there's merits to the methods they've learned. They've learned how to model things and go through their own processes. But it also means that at scale, when you look at how the consensus is built up, people are often basing all of their opinions based on the way that they've been taught to view the market. And because they've been taught to view the market through this lens, what that means is it means that they tend to congregate and cling to the same kinds of narratives, which can be a weakness, but it can sometimes be a strength as well. So consensus essentially becomes an echo of the same data through the exact same lens over and over and over again. Now, the big question is, how do we spot consensus? And by the way, the techniques I'm talking about here for spotting consensus, they do also apply to spotting your own narrative. You know, finding like a specific thing in the world, an observation, once you've confirmed it, tracking how the narrative of that is changing. But the reason I'm focusing on consensus here is because we're essentially waiting for consensus to flip to us, to our belief and idea. So therefore, understanding consensus is really the big thing that I look at to understand how things may be beginning to shift, because I separate finding an observable edge and then tracking the consensus, and essentially I'm waiting for consensus to come round to what I predicted, which also is ideal because it means that I don't have to necessarily be right about every prediction, because I'm waiting for the data and the consensus to confirm it. So I'm almost getting like a double confirmation in a way. And so how do we actually go ahead and spot consensus? So reading the sentiment of language, so that can be news headlines, it can be actually reading analyst articles. To get kind of the biggest bang for your buck, I find that looking at the most read articles is a better use, because at the end of the day, the more people are viewing a particular article, is going to have more weight than an article that has one view versus one that has 100,000 views. They're going to be different depending on how many people and who, what type of people that's made up of. Which that second question is going to be you're going to answer from understanding who the media outlet is or who the source is, because obviously different people watch different types of people. Institutional investors watch a certain type of person, but probably not, you know, your average YouTuber like me. So next one is analysts quoting identical stats or models. So analysts that are going over, you know, the standard company earnings things, or CPI or economic information about economies, and doing all the normal sorts of stuff that analysts do. Next one is going to be the market tone. So this is going to be, you know, is it risk on? Is it risk off? Are people feeling like they want to take risk? In other words, is the tone more defensive? Is it more aggressive? These sorts of things. And then finally, the main other thing would be data points that nobody questions anymore. So distributional data, data that makes up the averages, all these sorts of things. And then finally, I think I said finally before, but the social media stuff. So again, you really need to be careful of the audience that you're looking at here, but social media content can be quite a good tell. Comments, again, depends who you look at, but if you look at comments on, you know, notorious institutional analysts and kind of more prestigious stations and stuff, you can normally get a kind of decent idea. But the other ones I think are a little bit more, you can actually make, what's the word? You can get like a clearer idea, you know, because obviously this is qualitative, meaning you're not looking at like just strictly data. When you're gauging consensus, you're gauging emotion. And this is the thing with narratives, is you're not going to be dealing with numbers, you know, like you would if you were trying to understand the economic strength of a country. This is different. We're basing it off narrative. So our analysis can't just be based on numbers. It has to be a level of human interpretation of what people are saying. But that doesn't mean that it can't be systemized. It just means that it's less systematic than something that is purely based off maths. So in terms of how to track this, now right now I'm actually building a tool that is going to automate a lot of this, which is going to be really, really awesome. But for now, because that's proving difficult to do, There's a few main things. So the first one is recurring phrases, so language analysis. So this will be anything using NLP, obviously doing it manually, looking at the frequency of keywords showing up, the popularity of keywords, which leads me into my second point, which is tracking search trends. Search data is super valuable. Google Trends, news frequency, exploding topics, these sorts of places can be quite good. Exploding topics, maybe not so much for most of the investing that we might talk about, but Google Trends is typically pretty good. Next one is watching tone shifts in headlines. So positive, neutral, cautious. These sorts of angles can be really, really helpful, because if you track them over time, and again, this is the big thing, is it's not just about looking at it in isolation once. The big benefit is looking at it over time. What I really am trying to do at the moment with this tool that I'm building is I'm trying to have it so that it's really visually available, not just like the data, what it means, but also what it means and how it's changed over time and how that represents and relates to things in the past. So that's my goal. And that's going to be really, hopefully cool, but it's taking forever. Anyway, and then the last kind of main way is tracking divergence between story versus price action. So when price stops reacting to good news and the belief is tiring. So this is just a signal of basically how the markets are reacting to a story. And prices, because prices are relatively efficient, you will notice that price can often give you clues as to when stories are being priced in. But the reason that I put it last is just because often it can be a really bad and lagging or inconsistent method. So I much prefer to kind of lean on those other ones that I mentioned. Now, there are a lot more and you can go really in depth with this, but because I'm just trying to give you the overview here, I'm trying to explain the process, I didn't think it was the most appropriate to just shower you with endless data points. If you are interested in that, let me know in the comments. I'm more than happy to make a video on that. So the next thing is identifying the signs of decay with consensus. Now, this could be decaying in your favor, meaning they believe something that you thought was wrong for ages, and then they finally switch, so it's decaying in your favor, or it can be decaying against you. So you're in a trade or whatever, and then the consensus all catches up, and then it decays and moves into something else. At that point, that would be an exit. So you've got different types of decay, but you spot them in the exact same way. First one is journalist fatigue, so fewer new angles showing up. You'll find that this is a really, really good indicator. I find it's really, really good, but it just takes a little bit of tracking, again, which is why I kind of want to systemize some of this with this tool that I'm building. Contrarian statements start appearing but are ignored. So again, it's just that's kind of self-explanatory, I think. Price diverges from the narrative tone. So I kind of touched on this before. Price is not reacting to the narrative the same way that it was. It's a sign that things might be just starting to slow down. The market is becoming more rational. These are just a few of the things it could be. And then finally, the attention metrics flatten. So the coverage from the media goes down. The search volume goes down. These are just a few, there are many more. But basically, you're just looking for signs that things aren't as positive as they might seem. It might be an economic calendar release, and despite it being a positive surprise, which would normally, be either positive or positive for a stock or an asset, whatever, but instead the market either doesn't react or it reacts negatively. These can be the beginning signs that something is beginning to shift, because essentially when things do begin to shift, they can unwind quite quickly because the positioning has been skewed to one side. Now, if you're dealing with a larger market rather than kind of individual stocks, you can use tools like COT, which is the Commitment of Traders report. That uses the futures market to show positioning and show when positioning is really one-sided. It's a useful tool. It's a little bit lagged, but it's a useful tool to understand positioning beyond price, because price tells you one thing, but the positioning tells you something completely different. And so again, I can make a more in-depth video about that if you're interested. So why does mapping help? What's the point in all of this? Well, it tells you when a story is close to flipping. That's huge, because as I said before, it's not about being right. It's about being right and identifying when to size up when the consensus begins aligning with what you're doing, right? So if you can map it and you can map the story and you're tracking it, that is the edge, because the closer you are to the story, the better you are at systemizing, okay, this is how it's changing and when it's changing and why. That's going to be the biggest edge that you're going to get, right? With this particular approach anyway. Next thing is keeps you objective instead of being emotional. So there's a real thing, and I think one of the reasons a lot of people shy away from doing something that's like this, very narrative driven, is because it's not as numbers based. You're not looking at numbers. You're reading things that are almost intangible. You're picking up on stories which are by definition quite human, and they're qualitative, not quantitative. So people shy away from that because it seems less predictable. But the irony here is that because most people shy away from it, it can actually be more predictive of price. Because if everybody's analyzing the markets through quantitative mathematical models in very, very similar ways over and over again, then the margin for edge goes down and down and down and down until everyone's competing for this tiny little edge here. And because they're so focused on that, if they had paid attention to this other qualitative approach, the edge is larger if you do it correctly. So again, I mentioned keeps you objective instead of emotional. It also lets you focus on belief velocity. So this is how fast consensus is moving or stalling. It gives you an idea. Now, for those that are slightly more risk tolerant, this also doesn't mean that necessarily you're always waiting for a shift. For example, if okay, we're at this stage in the cycle, even though I know that, for example, I'm expecting a stock to go up, but it's going down at the moment, but I understand why it's going down because I know the story, I could still trade that down with lower risk and do something like that while waiting for the narrative to flip. That's going to be more likely of a scenario if I'm focusing on fewer assets that I trade rather than multiple. So there's lots of different ways to do it. Some people just prefer to have really high conviction and look at basically everything and see where that highest conviction is and only trade that. Other people like to just specialize in one or two particular asset classes or maybe one or two stocks and really master them. So what I just described, where you could sell it and align with the current consensus while you're waiting for the big move, that would probably be more akin to somebody who is focusing and specializing in a company or two or an asset or two, because they have more understanding of the whole story. They have become specialists in what they're doing, and so they have a bit of an edge in and of just doing that process. And so really the goal of this, right, is it's to make the idea of tracking narratives repeatable and not guesswork. Because when people think of narratives, they're like, oh, it's a bit vague, it's just a story, it's a feeling. Yeah, but there are signs and signals that are repeatable and make it relatively predictable. And that is a huge thing that I think so many people just sleep on. So that's the kind of main idea of what I've been trying to get across with the narratives. Now, I know this is a big overview, and so what I want to do in the next video is I'm going to show you lots of real world examples, both on a macroeconomic scale, kind of bigger asset classes, all the way down to individual companies, and show how that narrative shifted over time and how it was potentially tradable and when it was most tradable at each individual stage, because I think that's the best way to show you exactly what I mean. So if you're interested in that, click somewhere around this video. I'll also leave the link in the description box below. Take care and hope you enjoyed.